All right, welcome class. Let's go ahead and get started. We're going to talk today about capital structure, how a firm finances itself with either debt or equity. And before we get started with the slides, I wanted to take you through this capital structure-like exercise. We've got a couple scenarios here. Scenario one, we're going to invest $10, and then later in the scenario, we're going to think about how we can borrow money to supplement our investment. We'll just start with this basic exercise. We're investing $10, and we have various return schedules. They get earn 20%, and we lose some money, and so on and so forth. So let's start with this first one. We've invested $10 in the market, and we earn a return of 20%. What is our profit after this year of investing? So how much money do we have? We had $10 before. We earned 20%. How much do we have now? 12. All right, we have 12 total. Our profit is $2. All right, $2. And our return on equity, we'll assume our $10 is our equity. What is our return on equity? So remember that formula for return on equity. It's our net income, which is profit, divided by our equity that we had at stake, which is $10. So our return on equity is going to be 2. Someone said 2. I feel like there's a 2 in there for sure.
0.2.
0.2. Yeah, 0.2 is correct. You could also say 20%. So, 20%. Okay. Fantastic. So, suppose instead of making 20%, we lose 20%. What is our profit in that situation? No profit. Zero profit. Well, it's not zero. We wish it were zero. Yeah, it is a negative what?
2.
Negative $2. All right, and what's our ROE? It's not going to be positive. It's not going to be 0. We wish it were 0. It's going to be negative what? 20%. Outstanding. Okay, you're getting the idea. So suppose our return is negative 50%. What is our profit? I'll start you out with a negative sign and the dollar. $5. We lost $5. All right. What's our ROE? Negative 50%. All right. How about negative 60%? Negative how many dollars?
6.
6. And our ROE?
Negative 6.
Negative 60. Outstanding. Okay. So that's if we invested $10. Now suppose we think we're such a brilliant investor, we want to not only put our $10 at stake, we want to borrow $10 from the bank and add that to our investment pool. With me so far? So, same period. Suppose we earn 20%. What is our profit now? $4. Yes. Profit is $4. Actually, slight adjustment. Suppose we have to pay the bank 50 cents interest, plural, singular, interest, sorry about that, interest. What is our profit after we pay the bank 50 cents? $3.50. Outstanding. All right, so $3.50. And what is our ROE? It is not 20%. All right, so ROE is return, is going to be our profit. So $3.50 is going to be the top line. And equity is going to be, I'll give you 3 choices. 2 choices, actually. It's either going to be $10 or $20.
20?
It is not 20. So what does that leave us with?
10.
$10. All right, so we had $10 of our own money at stake. Where did we get the other $10? We borrowed it. So this is our equity, and this extra $10 is our debt. So our ROE is going to be $3.50 divided by 10, which is going to be what? 35%. All right, so let's pause there for a minute. What do we think? In this scenario, where we invested $10, return of $20 in the market, so the market was the same in both situations. We had an ROE of 20%, $2 profit. In this situation, profit $350, ROE of 35. What do you think about that? Pretty good, right? Because that's a positive thing. We made more money because we borrowed from the bank. That's positive. And what could be the disadvantage of this situation where we borrow the $10 from the bank?
Maybe there's a higher interest.
Okay, so higher interest would be bad. It wouldn't be that bad. We pay a little more interest. Suppose it was 6% interest. We pay 60 cents. Even if it was 10% interest, or I don't know, $1, whatever it was. Okay, yeah. So that's one thing. What else could be bad about this situation? It's all good. All right, it's all good so far. Let's take a look at this situation. Suppose our assets go down 20%. What is our profit in that situation?
Maybe negative 350.
Negative 350. You're on the right track. It's not negative 350.
Oh, you don't pay interest.
You still have to pay interest. The bankers get their money, believe you me. You still have to pay interest. I remember that Donald Trump debate where he's talking about the bankers who loaned him money. He's like, and they're terrible people, all right? These are not nice people, all right? They got their money, so you still have to pay the 50 cents. So what happened to your $20 after it went down 20%? It became 16. So you lost 4, plus you had to pay 50 cents. So what's your profit?
450.
Negative 450. Negative $4. Sorry, negative $4.50. $4.50. Okay, and what is your ROE?
Negative 45%.
Yeah, that sounds right to me. Negative 45%. Uh-oh, what happened there? If we had just invested our own $20, our own $10, we would have lost $2 and had an ROE to explain to the shareholders of negative 20%. So it was a bad year. We lost 20%. Now we're in a slightly different situation. We lost more money and we have to explain a loss to the shareholders of 45%. Now do we like this strategy of borrowing money and investing it? No. All right. Now it depends on the outcome. Maybe it could be really good, maybe it could be really bad, but what happened is it magnifies the risk. It magnified our return when it was positive, magnified our loss when it was negative. All right, so let's take a look at negative 50%. Suppose the market goes down 50%. What is our profit?
Negative 550.
I think not.
$20.
Yeah. I'll have the negative and the dollar sign for you to start us off.
Negative 1050.
Negative 1050. Okay. So negative 1050. How much money did we have invested? How much equity did we have invested in the first place?
10.
10. How much do we owe the bank? 10. So what do we do now? Venetia, what do we do now? We go to our grandmother and say, can you please loan me 50 cents just so I can make the interest payments before the guys come here to break my knees. But then after that, I've lost all my initial investment. So what's our ROE? I don't know. I don't even know. What is it?
105%.
Negative 105%. All right, let's do the 60% really quick. So what's our profit at 60%? We lost money, we lost negative dollar sign. We lost $12.50, right? $12.50. And our ROE is, I don't know, it's negative something absurd. 125. Okay. So we lost all our money, our $10 that we invested, plus we owe the bank $10. I guess we owe the bank $10 and we have $8.50 in our pocket. Yeah. So we have $8.50 in our pocket. We give it to the bank. The bank says, you still owe us. So we're coming after your house. We're coming after your car. We're coming after everything your company owns. Bankruptcy. This is the problem. This is the problem with leverage. Because we added that additional borrowed money to our investment strategy, we took on greater risk, and you could see the downside of that. The upside of that is fine. The downside that we don't like. And as an investor looking at this, I won't say it's just the downside we don't like, it's the volatility that makes the investors in our company worried. Remember when we talked about the capital asset pricing model, we saw that volatile returns investors did not like. So investors charged more, they discounted our cash flows more and said your investment's not worth as much. Any questions on this? All right. So I'm glad we were able to go through that example before we get started, because a lot of things we'll talk about in capital structure decisions, I'll be able to come back to that example and think about how this all relates when we start talking about it on a more complex level. Tonight, capital structure decisions. Do we just invest our own money? Do we borrow the $10? Do we borrow $20? What's the best strategy? I'll give you an overview. We'll talk about this idea of business versus financial risk, impact of debt on returns, which is exactly what we just went over in a simplified example, various theories for what is the best capital structure, the evidence of what people do in real life, and then we'll do an example of how you can choose the optimal capital structure to determine the greatest value for your firm. This is our flow chart that we like to reference. We always talk in this class about calculating value. We calculate value based on cash coming in. We discount that at a certain rate based on a number of factors, including risk. Tonight we'll see that the mix of debt and equity is one of those factors that determines the discount rate, determines the risk. We just saw how that debt increases the risk. That's one example of how that changes the discount rate. A couple basic definitions. You all know this. I'm just going to lay it out for some of the examples we'll do later in class. We're looking at calculating the value of the firm. It's determined by these free cash flows, specifically how much we discount those free cash flows using the weighted average cost of capital. Weighted average cost of capital is determined by the cost our equity holders demand and the cost, the charge that our debt holders demand, and by the weight of stock and the weight of debt. So how we choose to structure our company in this weight of our amount of stock versus the weight of amount of debt is going to feed into how much each of these types of owners are going to charge us. That's going to change the weighted average cost of capital. That's going to change the value of the firm. Of course, just as we talked about in 2 slides ago, this is the formula for value of the firm. It's these free cash flows from now until infinity. Broken down, weighted average cost of capital is the weight of the debt with this adjustment for taxes times the cost of the debt plus the weight of the stock times the cost of the stock. First thing I want to ask you as we get into this calculation, which of these two, this cost of debt or cost of equity, cost of stock, which one tends to be lower? Yeah, debt tends to be lower. Why is debt usually lower? What's that? Yep. Interest payments? Is that where you're going with this?
Yeah.
Yeah. So interest payments are guaranteed. We, as the owners of the company, must pay our debt owners their interest payments. If we have a bad year, we may or may not pay dividends. Not only must we pay our debt holders interest payments, what happens if the firm goes bankrupt? Who's in line first to get their money back? Debt holders. The banks, as Donald Trump would say. They're terrible people, all right? They're here. They just want their money. They don't care about me. That's why I use the bankruptcy laws. All right. So these bankers are here to get their money first. Anything that's left over is for the stockholders. So the stockholders are taking more risk, so they're going to charge a higher discount rate. So just based on that information alone, the fact that the cost of debt is usually lower than the cost of equity, which would you as the manager of a company be more inclined to use? Debt or equity? All right, Elaine says equity. Anyone else have another thought? What? Okay, another vote for equity. All right. Anyone else have another thought? So the debt holders are going to charge you less. They may charge you 6%. You pay 6% interest. The equity holders are going to demand more. They're going to say, based on your risk, we want an 11% return. Now, you have some flexibility when you're financing with equity that you don't have to pay them the interest payments right away. If you have a bad year, you might be able to explain to them. But there's going to come a time when they're going to say, you are not earning that 11% return that we demand. You all are fired. We're bringing in this team of Mercy College MBAs to take over for you. So, in the long run, you're going to need to generate a higher return for your equity holders than you are for your equity holders than you are for your debt holders. And specifically, just the math in this weighted average cost of capital, the more debt you have, the higher weight of debt you have versus stock, is that going to make, what's the effect that's going to have on WACC? So higher weight of debt will increase or decrease WACC. No, will decrease. Yeah, so the cost of debt is lower than the cost of stock. This is maybe 6%, this is maybe 11%. Not only is it lower to begin with, but another thing we didn't mention is there's this tax advantage of debt. So this is the before cost of debt is 6%, before tax cost of debt is 6%. With the tax effect, maybe it's 4.2%. So cost here is 4.2, cost here is 11. So if we have more of the 4.2, we're going to have a lower WACC. And if we have a lower WACC, how does that affect value? No. All right. And it's not going to decrease, and it's not going to stay the same, so it's going to increase debt, all right? So it's going to increase the value with the lower discount rate. Remember we said that a risky project is going to have a higher discount rate? If the bank thinks you're a risky investment, they're going to charge you a higher amount of interest. The same thing when your buddy from college comes to you and says, I've got this cool project for you. You're going to work it out on a timeline, and you're going to use a higher discount rate to discount those cash flows because they're less certain. So the higher discount rate, lower value. The higher this WACC, the lower the value. All right, so let me walk through that again, just because that's really important that we have a good understanding of that before we move forward. So I started this slide with the question, which between cost of debt and cost of stock, which tends to be lower? Cost of debt. Cost of debt tends to be lower. Why does the cost of debt tend to be lower? Because guaranteed interest payments, yeah, so the banks know they're getting some money. They're first in line if the company goes bankrupt. And then also there's this tax advantage of debt. So what happens to this weighted average cost of capital if we have a company with more debt? What happens to the weighted average cost of capital if we have a company with more debt? It decreases. Outstanding. Now, what happens to the value of the company if the WACC decreases? Increases. Yes. Yes. I'm going to go through that one more time just because of the pivotal importance, and I know it's late. If you have that clearly in your head, you're going to enjoy the rest of this lecture more. So, weighted average cost of capital is the weight of debt times, with the tax advantage times the cost of debt plus the weight of stock times the cost of stock. All right, between the cost of debt and cost of stock, which tends to be lower? Cost of debt for 3 reasons. Interest payments, first in line for bankruptcy, tax advantage. So, based on that alone, if we have a company with more debt, the weighted average cost of capital is going to go up, down, stay the same? Down. Lower WACC means what to value? Increases value. Awesome. Okay. So the impact of capital structure depends on the effect of debt on WACC. How does debt affect WACC? We went through a scenario, we know, and the lower WACC, which is typically a cause of more debt, increases value. Now, we're going to talk about business risk versus financial risk. First, let me explain business risk. This is just what you might think of a company taking risks. Risks about sales, risk about things that might happen in their line of business. You're not guaranteed a profit. Various things could happen. Just everything you as smart MBA students may have already thought about the risks a company takes. Uncertainty about demand, the price may vary, the input costs may vary. Liability, you may get sued if your product kills someone, who knows. Degree of operating leverage, we didn't really talk about this. I'll just explain it very, very briefly. If it confuses you, don't worry about it. Operating leverage, a firm that has high operating leverage has very high fixed costs compared to variable costs. So if a firm has very high fixed costs, it's hard for them to adjust because they have this huge payment that they need to pay no matter what. It's just fixed. So if demand decreases, it's hard for them to come out of that as profitable as they would. So this business risk, uncertainty leads to uncertainty in our EBIT, no bad return on invested capital. Depends on business factors such as competition, operating leverage, etc. So this is just business risk you take as a business owner. And you all have heard of all these things before, right? We're going to differentiate that from financial risk. Financial risk is additional risk concentrated on common stockholders when financial leverage is used. So this is the scenario we went through at the start of class. When we borrowed that extra $10, we saw some increased risk, right? No, we use the same return numbers. Suppose we just invested $10, we had a return of 20%, negative 20, negative 50, negative 60. And then we said, let's look at the exact same market return numbers. This top line, we'll call this the business risk. This is the risk you take by being in business. These next two lines, this is the added financial risk we have subjected our company to by borrowing that extra $10. Make sense? So business risk versus the financial risk. Business risk, what we always think of in terms of the normal business operations. Financial risk, think of that example where we borrowed the $10 and we took extra risk that had nothing to do with our performance in the market. This example on your slides is just a long version of the example we went through at the start of class. I'll go through it because it includes more of the numbers that we're used to working with in this class. We've got two firms. One is unlevered, and the other is levered. Unlevered means a firm has no debt. It's just equity. Levered means a firm has taken on some debt. And I guess they call it levered because it's like, the sort of the physics, the levering effect. So it magnifies the effect of returns. So suppose in this firm U, we have $20,000 of capital. It's all equity. We have a normal tax rate. Suppose our earnings before interest and taxes is $3,000. Our NOPAT, net operating profit after taxes, which is before interest, is $1,800. And our return on invested capital, this formula, of course, is the return, which is $1,800, divided by the invested capital of $20,000, is 9%. For our levered firm, the return on invested capital is the same because the invested capital, even though some of it is debt, some of it is equity, still comes out to 9% because this is a figure that just considers the entire invested capital. Suppose for this levered firm, though, of that $20,000 of capital, $10,000 is debt, $10,000 is equity. Same tax rate, same EBIT, same NOPAT, and of course the return on invested capital is the same. Where it gets different is when we start talking about the return on equity. Note that firm L has $10,000 of equity versus firm U has $20,000 of equity. So what do we think is going to happen to the return on equity for firm L just based on having a smaller amount of equity? So we have the same profit, the same NOPAT of $1,800, but instead of $20,000 in equity, we only have $10,000 in equity. So the return on equity is going to be higher, lower, the same. So the top line of our equation is going to be the same at 1,800. The bottom line is going to be smaller. It's almost like we have fewer equity investors to divide this profit among. So it's going to be higher. Does that make sense? And that's what the next slide spills out for us. This firm that is levered, this EBIT was $3,000, just the same as the unlevered firm. And we have some interest payments we need to pay to the bankers. So our earnings before taxes is a little bit less. We pay taxes, and we get a little bit of a tax shield with this firm that is levered. We pay $720 rather than $1,200 because debt gives us that tax advantage. We can deduct the interest payments. Our net income is going to be a little bit lower as a result of the interest payments, $1,080. We talked about our return on invested capital is going to be 9% in both cases. Return on equity, however, for the levered firm is going to be 10.8 rather than the 9% for the unlevered firm. The unlevered firm, it's all the same. Invested capital, it's all equity. So for this net income of $1,800 over equity, it's all equity of $20,000. 9% stays the same. But the levered firm magnifies that risk. Just the same way we did the example at the beginning of class. Does that make sense? If EBIT increases, in the previous slide it was 3,000, now it's 4,000. Take a look at that. Tell me what happened to the return on invested capital and the return on equity. Just take a minute to look at that slide and explain these four cells to me. All right, somebody want to take a crack? In this scenario, our firm made more money, had $4,000 in EBIT. I want somebody to tell me what's going on with these bottom two rows. Take a shot, Frida. Yeah, it increased because we had more money, but it was the same.
It was the same.
Yep. Yep.
And the return on equity increased for both firms, but firm L had a higher equity still.
This firm had a higher return on equity.
Return on equity than firm U.
Yes. Why did firm L have a higher return on equity? The tax. Okay, it benefited from a tax advantage. That's part of it. But the real reason is the smaller amount of equity. This is return divided up among $10,000 worth of shareholders. This is a return divided this 2,400 return is divided up amongst $20,000 worth of shareholders. Same thing with our example in the beginning. Note how these two figures are different. Scenario 1, 20% ROE. The market performance is 20%. Exact same market performance, but all of a sudden our ROE is 35%. Goes because we have that smaller, invested equity to begin with. Does that make sense? All right. Now, same thing that happened in our example before class. We know that if the income and bottom line, top line goes up, that's great for our enhanced return on equity. Debt will magnify the return, but what if the income goes down? Then the equity holders are going to be like, oh, man, why'd you have to borrow all that money? So suppose EBIT goes down to 2,000 instead of the 3,000 in the initial example. We're still going to have to pay the interest. EBIT's a little lower, taxes are a little bit lower, net income is of course lower, and our return on equity is going to be magnified in a less glamorous fashion. We dislike it. Increases the risk. So leverage magnifies risk and return. Who can someone just talk that out for me? What do we mean by that? Leverage magnifies the risk and return. Seems in a way like a simple concept, but the more you can articulate it, the more you can get your head around it. As you get further and further into your careers in finance, all sorts of fun things that happen as a result of your understanding of this. So what do I mean when I say leverage magnifies risk and return? Danelle, want to take a shot at it for us? Venetia, help us out. Leverage magnifies risk and return.
Well, debt magnifies the risk by you have to pay them back, so they are first to get paid.
Yes.
And the return is that it's less for the shareholders.
Yeah, the return. So the return, when you have a small, I guess maybe one of the best ways to sum it up, when you have a smaller pool of equity, then the return is magnified as a result. A larger pool of equity, the return is less magnified. So take away from this discussion and from the example before class, this leverage magnifies risk. Has anyone ever heard of a leveraged buyout before? It's when investment bankers come in, they borrow a bunch of money, and they just load up the company with debt. And they have some way of using that process to sell the company for more money later, but the company goes through a period of very high risk where the managers are just very focused and they have to work hard on generating profits because there's so much debt. Anyway, I won't really go into that, but leverage magnifies risk and return. So, this brings us to some theories. We've talked about a couple of things in terms of deciding how much debt and how much equity we should have in a company, or our company, or a company maybe we're consulting for. And we started with this idea that, well, we have two main themes that we've discussed so far. One is that debt is less costly. So more debt increases value. The other side of that is debt increases risk. So we know that debt increases value because it's less costly. We also know that debt increases risk. So we need to find that optimal balance. Make sense? Somewhere where we can get the lowest whack and the highest value. And to get us there, we've got a number of academic theories that we're going to discuss. First is the M&M theory. These two guys, Modigliani and Miller, or Merton, one of those two, I forget. Merton, Miller, something. We'll just say M&M theory. Glad no one's listening. My professor next door just shoot me if you knew I was mixing those up. We'll call it the M&M theory. First, I'll go through a scenario. If there's no taxes, what's the optimal capital structure? And then, of course, taxes exist, so we need to incorporate that. Then, what is the optimal capital structure? Then we'll go over a third theory, or second theory, trade-off theory. Signaling theory, what sort of signal does it send to the market if we issue equity or issue debt? Pecking order, which is another theory. We'll go over all this. And debt financing as a managerial constraint, as well as windows of opportunity. These are 1, 2, 3, 4, 5, 6 things, and the first one, the M&M theory, has 2 parts. We will discuss that are going to help us as managers of a company make the decision how much debt should we have and how much equity we should have. Does that make sense in terms of the overview? So we're going to start off with the M theory. First, by assuming no taxes. We assume no taxes just so we can clarify how these numbers work. So let's go back to our firm U versus firm L. Remember the initial example, suppose they have $3,000 in EBIT. The levered firm is paying interest to these bankers. The net income is lower as a result. And what the MM theory says is that even though we need to make this interest payment to the bankers, the fact that half the firm is financed with debt does not change the value of the firm, because we have that interest payment going to the debt owners of the company, and we have the net income going to the equity holders of the company. In both cases, there's a total of $3,000 going to the owners of the company. If the firm is unlevered, $3,000 goes straight to the shareholders. If the firm is levered, $1,800 goes to the shareholders, $1,200 goes to the debt holders, but a total of $3,000 goes to the owners of the company. So if the cash flows for both these are the same, then the value is the same. So that's step one in the MM theory, assuming no taxes. Value of the firm does not change, whether it's levered or unlevered. Now, we all know that there are taxes. So the first thing that these two folks looked at is the fact that taxes, there's a benefit to equity or debt because of taxes. And we know that there's a benefit to debt financing because those interest payments are tax deductible. So they found that that benefit created more value for a levered firm. And when I say a levered firm, what do I mean by that? It has debt. Okay, so this is just the zero taxes. The levered firm is the same as the unlevered firm. Because the cash flows are equal, WACCs are equal, assuming some things that are only true in academics. But if corporate taxes are a factor, tax laws allow interest to be deducted, which reduces taxes paid by levered firms. Therefore, more cash flow goes to investors when taxes, and less taxes when leverage is used. In other words, debt shields some of the firm's cash flows from taxes. So because of this tax effect, we like taxes, or we like levered firms, because they increase the value. So M&M said the value of a levered firm is equal to the value of an unlevered firm plus some tax benefit. This top line or second line here is the key takeaway for this slide. The value of a levered firm is the same as the value of the unlevered firm plus a tax benefit. Show total cash flows is equal to plus an additional amount due to deductibility. Cash flow levered equal cash flow unlevered plus tax benefit. Is the value of this tax benefit? Well, the value of the tax benefit is the tax rate times the amount of debt. So if the tax rate is, say, 40%, and we have $10,000 in debt, how much value does this little piece add to a levered firm? Tax rate is 40%. In our previous example, $10,000 of debt. How much is this little extra worth? Tax rate 40%. Amount of debt $10,000. 4,000. Yeah. So because of the tax effect, this levered firm is going to be worth $4,000 more, solely because of the tax effect. Does that make sense? So this is an important first step. 40%, every dollar of debt adds 40 cents of value to the firm. So let's take a look at this graph. We have the value of the firm on the vertical axis. Higher is better. Here is 0. On the horizontal axis, we have debt starting at 0 and increasing. More debt as we go to the right on the graph. This value of an unlevered firm stays the same. If it's not levered, there's no debt. It doesn't matter how much debt you add. Well, it just stays the same, I guess. If it's unlevered, it stays the same. But as we increase debt, the value of the levered firm goes up. So based just on this information, what should we do? How can we maximize the value of the firm? Debt. More debt?
More risk.
More risk. Okay, well that comes next. So my question, the first question is, based on this, what should we do? Your answer is absolutely right. More debt. All right, what's the limit? What's the problem? And you said it. Stopped you when you said it. You said risk. Yeah, you said risk. So we need to find that optimal trade-off. But just based on the tax effect, more debt equals more value to the firm. And this is going to bring us to our trade-off theory. So we've all gone over the MM theory of zero taxes, MM theory with corporate taxes, which says, one with corporate taxes says more debt equals more value. But we know that increases risk. We need to think of the trade-off. The previous theory, MM, ignores bankruptcy costs. At low levels, low leverage levels, tax benefits outweigh the bankruptcy cost. But as we get more and more levered, more and more debt, the bankruptcy cost outweigh the tax benefits. We need to find the optimal balance. Let's do so by looking at this graph. Similar graph as before. Value of the firm is on the vertical axis. Higher is better, lower is not good. This line here indicates how much debt we're taking. Value of an unlevered firm stays the same no matter what. Value of a levered firm, this is the advantage of the tax shield. So the more debt we have, as we go further and further to the right on this axis, the value of the tax shield goes up. And what we're adding to it is this distressed cost. As we take on more and more debt, we take on more and more risk. More and more interest payments we need to make, and more chance of the return fluctuating to where we could go bankrupt like that. Remember when we used the example at the beginning of class, suppose we had a 60% negative return, all our equity was gone and we still owed the bank $2.50. The more debt we take on, the greater chance of that happening. Investors are going to look at that, and they're going to say, you're taking on a lot of risk. So what are they going to do as they're sitting in their little cubicles trying to figure out the value of our firm, and they're using a weighted average cost of capital for us? They're going to look at this, they're going to say, gosh, you're so levered, you have so much risk, you might go into bankruptcy. So as they're calculating the weighted average cost of capital for us, is that going to be high or low?
High.
It's going to be high. All right, and when they type in that high weighted average cost of capital, what is it going to spit out on their Excel sheet for the value of our firm? It's going to be low. So as we put on more and more debt, the possibility of bankruptcy increases. So even the equity investors, it's not just the debt investors, it's the equity investors are looking at us and saying, you may go bankrupt because you have to pay back all your debt, so I'm not going to give you more of my equity money that's going to be last in line when you do go bankrupt. So if we add all that together, we get this blue line, which is the value of the levered firm. As we add more and more debt, it goes up, and there gets to be a point where it starts going down. So where might you say our optimal capital structure exists on this graph? Outstanding. Venetia says it's right there. Yeah. Yeah. So that's where that's where we want to think about our optimal capital structure. So we are the Mercy College consultants. We come into the company and say, this is where you should be in terms of your capital structure. If you're too far here, take out some loans, repurchase stock, and get to here. If you're too far here, pay off some of those loans, maybe issue stock, but definitely pay off some of those loans and get back to here. So that's the trade-off theory. We want to be at this point. Any questions on that? Now, another thing that's going to be going on in the minds of our managers that we might be helping, consulting, is what sort of signal issuing debt or issuing equity is going to send to the market. So we mentioned if they're here, we might say, take on some more debt. If we said they're here, we might say, issue or pay off some debt, or maybe issue stock. There's going to be some things going on in their minds, and should be going on in our minds. What sort of signals might the market interpret if a firm decides to issue debt? And what sort of signals would the market interpret if the firm decides to issue new stock? And it has to do with the price of the stock and where the price is at the current time. Furthermore, it has to do with what management thinks about the price of that stock. And we discussed it briefly in previous classes. If the price of stock is really high and the firm issues debt, the actors in the market, the firm issues new stock. The price of stock is really high. The managers say, I want to issue more stock. The market says, the investors in the market say, you're only issuing stock because you think the price is really high. In fact, you're probably issuing stock because you think the price is too high. You think it's overvalued. Does that make sense? So there's been a run-up in stock price. Management looks at that and says, wow, that's really high. In fact, it's too high. Let's capitalize on that high price tag right now and issue stock. Sell more stock. If it's low, they may say, no, we're not going to issue stock because the price is low. Our company is worth more than the market thinks it's worth, so we're not going to sell stock right now. We're going to issue debt. So signaling theory. What sort of signal does it send to the market if management decides to issue stock? Anisha? Yeah, they always want to sell the stock. If they issue stock, they want to sell it. But what signal does it send to the market in terms of where the stock price is and where the stock price should be? So management decides to issue stock. They're going to sell stock is up to $120 per share. Management is issuing more stock. All right, we want more people to give us $120, and we're going to give you each a share of stock for that $120. What signal, based on what we just said, does that send to the market? Sell more stock? Okay. It's overvalued. Yes, that is the signal we're talking about right now. Again, there are different signals, different contexts we'll talk about, and I understand it's hard to keep them all straight. But just in terms of this signaling theory right now, if management decides to issue stock, the market's going to say, whoa, you're only issuing stock because it's overvalued. Sends the overvalued signal to the market. What do the investors in the market do as a result of receiving that signal? They might not buy it. They might sell that company's stock. They might engage in shorting that company's stock. and thus driving the price down.
So that's a loss to the company.
Yes, it's a loss to the company. It's a loss to you as the manager of the company. The stockholders are going to come to you and like, dude, what are you doing to me? We want the stock price to go up, not down. And the stock price was going up until you decided to cash in on it and try to issue all this stock. And now everybody thinks that you're just selling them something that's overvalued. And now my IRA is down. My slush fund investment is down. I'm not going to be able to go to the Cancun. You're in Cancun next year. Signaling theory. Stock price goes up. Management sells. They're signaling that it's potentially overvalued. Okay. The previous theory, the MM theory, assumes that managers have the same information, but that's not true. Managers often have better information. Thus, they would sell stock if it's overvalued, sell bonds if stock is undervalued. Investors know this, so they view stock as a negative signal. Implications for the managers. So, given all that, what would the managers do? Do they want to have that discussion with this investor who says, why did you signal the market that my stock is overvalued? Now it's crashed as a result of that huge stock issue you did. So what might managers do instead if they need cash? Not issue stock because that's potentially a negative signal. They might issue debt. Issue debt. Yeah. Based on this theory, they might issue debt. Or if they have the money in their bank for retained earnings, they might use that money as well. So this would be a reason that we need to be aware of. The managers want to be very careful about issuing stock. Again, as we go even tonight, as we go through various scenarios, you're going to see, all right, maybe on the one hand they might do this, on the other hand they might do that. And I know that sometimes it's tough to keep straight in your head, so I suggest we just think of it one theory at a time. Right now we're on the signaling theory. So the signaling theory says stock issue sends a signal that stock is overvalued. So managers, based on that, might like to do something else. Any questions on that? So this brings us to the pecking order theory, which tells us what managers might want to do as a result. Pecking order has 3 points to the pecking order. Managers first, if possible, would like to use funds out of retained earnings. That way they don't have to issue stock. They don't have to issue debt. There's less scrutiny on them. People don't say you're sending a good signal, a bad signal. They just use retained earnings. What they might want to do second is issue debt. Because they don't want to issue stock, which could send a negative signal. If they still need money after that, the third thing they might do, if they have to, is issue equity. So the pecking order states, primarily because of the signals that might be sent, first, use internally generated funds, no flotation costs, no negative signals. More funds are needed, issue debt, lower flotation, and not a negative signal. Last resort, firms issue equity. So, pecking order theory. All right, what are the 3 steps in the pecking order theory? Use retained earnings first. Issue debt second. Issue equity last. Why is issuing equity the last resort? It is their money, and they're going to be mad about something potentially.
Oh, issuing the value?
Yes, yes. It sends a
signal that it's overvalued.
signal that's overvalued. Okay. Any questions on that? one other little thing I want to throw in. Sometimes debt financing is used as a management constraint. This agency problem that we talked about, I think in last class, sometimes owners of a firm will like a company to take on a lot of debt because it keeps the managers on a short leash. They have to pay these interest payments, and if their returns are going to go negative, then that could very much hurt the company in a way that's going to keep the managers focused. So often you will hear about owners of a company saying, I want a highly levered company to keep the management on a short leash. One agency problem is that managers can use corporate funds for non-value maximizing purposes, so the use of financial leverages forces discipline to avoid perks and non-value adding acquisitions. Does that make sense? Almost just like a little aside that we want to keep in mind. Now, there's another other side of that. Sometimes there's an underinvestment problem. Debt increases risk of financial distress, so therefore managers might avoid risky projects even if they have a positive NPV. This, as I understand it, is not as common of a problem. More often, owners of a company like to use debt to keep the managers disciplined. But this problem could surface as a result. The managers, you just might put so much pressure on the managers that they're not doing their jobs effectively because they don't want to take risks. Another, I guess I might call it an aside. Now, how you doing? Want to take a quick break? That was a lot. Let's take a quick break. Let's take 8 minutes till 7:40. There was a lot to chew on, so let's just let that ruminate in your minds for a minute. Let's come back at 7:40.
I gotta do one. Jennifer Rice is honey.
What was the learning experience? Hey, you guys. One cop, how long? Hey, one cop, 6 hours. 2 cops, how long? 90 minutes. It's not linear. The numbers are all over the place. It's not. But you just told me something. You told me that there were 1 cop, 2 cops. What happened to utilization? What was the utilization of 1 cop? One cop, what was wrong?
And I don't want to say true because it's not true. You know, because I can make a mess. Like, yeah, that's the difference. I didn't know that. My friend was telling me because she didn't know that.
Okay, hey, choose this model right here, the MVP model. Hey, God bless you. Next one. How many servers did we just have in this model? Two. Okay, how many was programmed in this model? What was new? So, part of the learning experience. We went through it. Suppositorio.
All right, let's go ahead and get started again. We are managers or financial consultants trying to decide on the optimal capital structure. We've looked at a number of different theories of capital structure. First we looked at is the MM theory, assuming no taxes. And what did that theory stick? That's the takeaway there. If there are no taxes, what is the optimal capital structure? What's that? So, all right, so debt what?
Alright, I guess if it's below the optimum
Okay, so I'll summarize. I know it's confusing kind of how to put it in context. So the MM theory. So we're asking the question, what's the optimal capital structure? How much debt versus how much equity? So there are three theories we looked at. The first one had two parts. The MM theory, assuming no taxes, said it doesn't matter. Whatever you want to do is good. Doesn't matter. Capital structure does not affect value if there are no taxes. The second part of that theory says, well, there are taxes. Everyone knows there are taxes. So what is the optimal capital structure because of taxes according to the MM theory, part 2? All right, so according to the MM theories with corporate taxes, what is the optimal capital structure? Is it 0% debt, 50% debt, 100% debt? But that's the first part. With no taxes, doesn't matter. But since there are taxes, what do you got, Benita? Because there are taxes, we should use more debt. Yes. All right, so that's what MM theory part 2 says. We should use as much debt as possible. MM theory part 1 says, doesn't matter. MM theory part 2 says, use as much debt as possible. Right, and that's where it ended with the MM theory. And then, as we walk into this finance company to give them our high-priced consulting advice, we're going to have more than one theory. We're going to pull out our knowledge of the trade-off theory. The trade-off theory tells us what? What is the optimal capital structure based on the trade-off theory?
The decision is dictated by the waiting time. Right here. A waiting time of 5 seconds.
What's that? Yeah, so we're trying to decide the optimal capital structure for some company. All right, and we know various theories that are going to help us make that decision. If we were just to base our decision on the MM theory, no taxes, we would say the answer is, it doesn't, Mr. Client, Mrs. Client, it doesn't matter. If we were to use the information based on the MM theory part 2, we would say, Ms. Client, Mr. Client, as much debt as you can possibly fit into your company structure, do it. Because that's going to increase the value of your firm. We also have some other things we know, being finance students. One of them is the trade-off theory. So trade-off theory is going to give us a different answer for what the optimal capital structure is, the optimal mix of debt and equity.
So where your cost equals your benefit.
Yeah, cost. So what's the cost? What's the benefit? What are the two things we're balancing in the trade-off theory?
The cost and
Go ahead. No? We're balancing two things in the trade-off theory. Tax, yes. Tax what? Selena?
tax shield.
Tax shield. Tax shield is benefit. Yeah. So we want more debt because we get the tax shield. All right, but it's a trade-off. What are we balancing with the benefit of the tax shield? Cost of financial distress. Outstanding. So, we know the MM theory. Now we know the trade-off theory. We say, all right, you need to find the optimal mix between benefiting from more debt in the tax shield and getting too much debt and suffering from risk of financial distress. We need to balance tax benefit and risk of financial distress. We also know something else. The reason why we get to charge this company $700 an hour for our services. We know the signaling theory. And we're going to factor that into our advice to this company when they ask us what the optimal capital structure is. What do we know about the signaling theory?
They're selling stock that's overvalued.
They're selling stock, they're going to send a signal that it's overvalued. So based just on that, we might be inclined to tell them, don't sell stock. Don't sell stock. Now maybe you can make a case for it. Maybe everyone knows that some regulation just changed, that some merger just happened, and the market is going to say, wow, you have a lot of investment opportunities, your company is looking good, and you want to capitalize on that by issuing more stock. And you may be able to pitch that to the market and explain, there's no asymmetric information problem. We're not saying it's overvalued, I promise. So please buy our stock and don't penalize us by driving the price down. But in our arsenal of things that we're going to tell this company, we understand the signaling theory could be viewed as a negative signal if we issue stock. So that brings us to our, I guess, third or fourth or whatever theory, the pecking order theory, which is going to tell us how we are going to advise this company on their optimal capital structure, how they should get funds if they need it. It's going to be a rank order of three things. Retained earnings first, and then comes debt, issuing debt, and last, if you have to, comes issuing debt equity. Okay, so that's the main bulk, it's the main important stuff we talked about. We also threw in this little aside that debt can be used as a management constraint to keep a tight leash on your managers, keep them focused, keep them disciplined. Now we're going to talk about an opportunity set and how that's going to affect how we should approach capital structure, our potential investment opportunities, and then we're going to look at some empirical evidence, which is going to tell us what happens in the real world. We've just learned the theories. After we get done with this topic, we're going to talk about what happens actually in the real world. But first, opportunity set is just our potential investment opportunities. So if we think we have a lot of investment opportunities coming up in the next 1 year, 2 year, 3 years, we might want to maintain what we'll call a reserve borrowing capacity. Meaning we may not want to be right at that optimal level. We may not want to be right here. We might want to advise our client to be right here. Because if they have investment opportunities coming up and they need to borrow money, they have some room to borrow money before it erodes the value of their firm. So we might encourage them, if they have a good opportunity investment set, a good investment opportunity set, we might encourage them to maintain what we'll call reserve borrowing capacity. That make sense? So, firms with many investment opportunities should maintain this reserve borrowing capacity, especially if they have problems with asymmetric information. Now, what does that mean, asymmetric information? This is just reinforcing something we've been talking about all class. It's nothing new, so don't freak out. What do you think it means, though? Asymmetric information. Not the same. The market has different information than we have. We know that our company is great. We know it has so much opportunity, so much growth development. But if we issue stock, the market doesn't know that, and they're going to penalize us for that. So, if we think we have a lot of potential projects that we'll need to borrow money for, and we have problems with asymmetric information, then we're going to maintain reserve borrowing capacity. We're going to be a little bit further down, further to the left on that debt graph that we showed earlier. Now, last but not least, market timing theory. Now, this is going to be a little confusing, I know, because I've just gone over the rationale for signaling hypothesis, and I'm going to throw at you the complete opposite of it and say, well, it's just another theory. So what do you think the market timing theory might dictate about how a company should form its capital structure? I'll give you a hint. It has to do with the stock price and whether the stock price is high or low. What's that? Interest? So the question is, should the firm issue stock or issue debt?
Stock price is high.
Stock price is high, what should they do?
Issue stock.
Issue stock. Okay, all right, I told you it was going to be confusing. All right, we just said that that's potentially a negative signal, and I'm sorry for that. But you You have to understand that there's different theories that finance consultants need to be aware of. Yes?
Why don't they issue limited number of stocks, like in consistent times, not like once in 6 months or something?
Now we're talking. All right, we've got a good strategy here. If we dump all this stock on the market right away, everybody's going to say, whoa, they're trying to capitalize on overvalued stock, and they want us to buy before they figure it out. We've got a plan, an algorithm. Sure, that's fine. You also might think, if you're going to use this market timing theory, you might think of how you're going to pitch this to the market. And I just gave a quick example of saying, I promise our stock is not overvalued. Look at this new regulation that's going to help us. Look at this new company we opened in China. Look at X, Y, and Z. We're issuing new stock because we want to take advantage of these opportunities, not because it's overvalued. So the market timing theory would dictate managers try to time the market, issue equity when market is high after a big stock run-up, issue debt when stock market is low, issue short-term debt when the term structure is upward sloping, and long-term debt when it is relatively flat. Does anyone know what term structure of interest rate is? All right. Well, you've at least heard it. Essentially what it is, it's the interest rate on debt. And it starts with low interest or short-term interest rates and goes up to longer yield interest rates. You've heard of this before? So if we were to draw I'm not going to explain. Right? Just upward sloping means that higher interest rates on longer term debt. Okay, so market timing theory. Now, what happens in the real world? We're going to go through a list of things that researchers noticed happen in the real world. We'll try to think about how it fits into our academic theories that we learned for our fuller understanding of how these things work in the real world. Tax benefits are important. Companies think that. At optimal capital structure, debt adds about 10 to 20 cents of value on average. Now remember the MM theory that for every dollar of debt, it would add tax times that dollar amount. And if the tax rate is 40%, you would expect 40 cents for every dollar. But as it gets closer and closer to the optimal structure, this is what the empirical evidence says. Taking on a dollar of debt will add 10 to 20 cents. Bankruptcies are costly. I was surprised by this. Bankruptcy costs can cost up to 10 to 20% of firm value. It seemed low. It seemed low in what your textbook estimated as the bankruptcy cost. If a company goes bankrupt, it'll be worth 80% of what it was before bankruptcy. Does that surprise any of you? Yeah. Maybe just because we're used to hearing about bankruptcy being a terrible thing. But that's what the evidence says. Bankruptcy can cost 10 to 20% of the value of the firm. So it's a significant risk. Still 20%. In the real world, firms have these debt equity targets, 40% debt, 60% equity, but don't make quick corrections when stock prices change. Average speed of adjustment from capital structure is about 30% per year. So say a company has $100 million more debt than it wants to have based on its target structure. It might decrease $30 million of that in the first year. If a firm has a high cash flow, it might increase or decrease 50% of that in the first year. Firms to change their capital structure the fastest are firms with a high cash flow that are above target, meaning they have a lot more debt than they would like to have based on their target. So if they have a bunch of debt above their target and they have a bunch of cash flow, they are likely to change that at the rate of 70% per year and pay off that debt as fast as possible. Because the empirical evidence apparently says that the lost value from being above target, i.e. having too much debt, is bigger than the lost value from being below target. So let's just stop and refresh. What do we mean by the lost value from being above target? What does that mean? There's two components I want you to be able to explain. One is the lost value, and the other is being above target. I'll give you a hint. The lost value, it either has to do with the lost value of not taking advantage of the taxes you can get from debt, or it has to do with getting too close to the risk of bankruptcy. So again, we're consultants. We're telling this company what is the optimal capital structure. We're saying you should have 30% debt, 40% debt. And there's an optimal amount that we're going to recommend. If they're below that optimal amount, we're going to say they have too little debt. If they're above that optimal amount, we're going to say they have too much debt. So if they're below and have too little debt, where are they losing value? According to the trade-off theory. They're losing value because they're not taking advantage of tax benefit of debt. Absolutely. Now, if they're above target, they have too much debt, they're losing value because of what? Risk of bankruptcy. Absolutely. So, lost value from being above target, meaning have too much debt, is bigger than the lost value from being below target. So then back to value. All right, where is our value eroding? It's these financial analysts in their cubicles constructing the weighted average cost of capital. And as we get closer and closer to risk of bankruptcy, what's happening to our weighted average cost of capital? Decrease? All right, you're on the right track. You said decrease or increase, but not quite. It's going to the other one. Yeah, it's going to increase. All right, as we're taking on more and more debt, the financial analysts in their cubicles, they're increasing our weighted average cost of capital. What happens when our WACC increases? Absolutely. Okay. Above target, distress costs rise very rapidly. That's the problem with being above target. Sometimes companies will deliberately increase debt above target to take advantage of unexpected investment opportunity. So in this case, maybe they should have left a reserve borrowing capacity, right? Left some room to issue more debt in case some investment opportunities came up. All right, so again, back to empirical evidence, what happens in the real world. After big stock price run-ups, debt ratio falls, but firms tend to issue equity instead of debt. Which theory would explain that? And I'll give you a hint. It's either the market timing theory or the signaling hypothesis. And I'll read the sentence again. The sentence is, empirical evidence, what happens in the real world, after big stock price run-ups, debt ratio falls, so stock goes up, so they keep the same amount. Market timing. You got it. That makes sense to everyone? Inconsistent with trade-off model, inconsistent with pecking order model, all the stuff we spend our valuable time and energy learning in school is inconsistent with that most of the time, but consistent with windows of opportunity, market timing theory. Firms, especially with those with growth options and asymmetric information, tend to maintain excess borrowing capacity. Yeah, so firms do this. It's a thing. This excess borrowing capacity. Stay a little bit low on your debt ratios so that you can borrow money if you need to if something big comes up. Apparently, the empirical evidence says that's a thing that happens in the real world. Now, implications for the managers. Implications for us as managers or us as financial consultants telling people about what they should do on optimal capital structure. Take advantage of tax benefits by issuing debt. So that's one thing we are likely to tell our client. Take advantage of this tax benefit. Issue debt. You're going to increase the value of your firm, especially if we're in a high tax environment. you're a company that has stable sales, low business risk. Why is this important? Why might we be more likely to tell our client, take advantage of this debt, this tax benefit of debt, if they have stable sales and low business risk? Why would it be more likely to tell them that they should take advantage of the benefit of debt? Has to do with this example we did in class. In particular, this part and this part. So we're not only consulting on the amount of financial risk they should take, we're also gaining an understanding of their business risk. And this top line, I might describe as business risk. You could have bad returns. This bottom two lines is the financial risk, the risk you're taking on by issuing more debt. I'll give you a few seconds to think about that while I put the screen down. Oh, that's good. Okay, so we as the smart financial consultants, we're charging some insane fee here, $500-600 an hour, just so the finance companies listen to what we say about how they should structure their capital structure. We might tell them, take advantage of tax benefits by issuing debt, if and only if they have stable sales and low business risk. The reason we would be more likely to tell them that is because of the risk associated with taking on more debt. This risk. You ever notice when we went down, the risk was magnified. And if they're an unstable company and they have a lot of risk, then we're not going to tell them to take on more debt. If they're a company that has stable sales, low business risk, we're going to say do it. Does that make sense? Also might want to encourage these managers to maintain an excess borrowing capacity so that they don't have to issue stock, that they have some room to issue debt, especially if they're in a risky situation. They have volatile sales, high business risk, many potential business opportunities, special purpose assets. So this has to do with the amount of risk that a company might be facing, just as in the last slide. If they're a risky firm, then we're going to tell them you better maintain some borrowing capacity. You do not want to put yourself in a situation where you're going to have to issue equity and issue new stocks in a potentially very risky, volatile environment. Okay, we've talked about this in theory, but it turns out it's actually true in the real world. If a manager has asymmetric information regarding the firm's prospects, then avoid issuing equity if actual prospects are better than the market perceives. Someone sum that up for me? I'll give you a hint, this is not a trick question. I just want you to articulate what we've talked about throughout class. Just put this in your own words for us. The manager has asymmetric information, so you're going to need to explain that. You're going to need to explain why they should avoid issuing equity. So, asymmetric information, why does that mean they should avoid issuing equity?
Steady.
Asymmetric means not the same, meaning management has different information than the market has. Yes, all right, so you have asymmetric information problems. Management thinks the prospects are good. The market does not think the prospects are good. We as the consultants are going to tell them, do or do not issue equity. Do not. Do not, because you're a firm that has asymmetric problems with information, so you should avoid issuing equity, because that's going to send a negative signal to the market. Now, of course, there are reasons why we could tell them they should. We could just pull out another theory. All right. Doing my best to make sure you have an understanding of all these. Always consider the impact of capital structure choices on lenders, credit ratings. So as we take on more debt, people are going to be less likely to lend us money, charge us higher interest rates. The rating agencies might rate us as a higher risk. We need to be aware of all that. Questions, comments? The rest of class, it takes about 20 minutes here. We're going to go through an optimal capital structure example. We're going to use that trade-off theory, where debt gives us an advantage because of the tax benefit. But if we take on too much debt, we get closer and closer to possibility of financial distress. And we want to find that optimal point. So, suppose we've got this company, has a beta of 1, we've got some information on the risk-free rate, the risk premium, the tax rate. We can take this information and we can calculate the cost of equity using our capital asset pricing model. GAAP-M is the return required on the stock, is the risk-free rate, plus beta times the risk premium for the market. In this particular example, we know the risk-free rate is 6%, beta is 1, market risk premium is 6%, the required return for stock is 12%. Currently, suppose we have no debt. We're going to think about whether or not we should encourage this company to take on debt. So the weighted average cost of capital is just the cost of equity at 12%. Current value of operations. So let's suppose this firm has a free cash flow of $30 million a year. So assume the firm does not expect growth. It's just going to be a steady $30 million forever for purposes of this example. Now, does anyone remember that perpetuity formula we went over in class 1? Or if you have a stream of cash forever and ever, how do you value that? All right, it was the cash flow divided by the interest rate. So if the current interest rates are 5% and you've got a cash flow forever and ever of $1 million, you take $1 million divided by 5%, which gives you what? God sure missed it. $1 million divided by 5%. 20 million. Yep. So if I say I'm going to give you $1 million for the rest of forever, for eternity, current interest rates are 5%, the value of me giving that to you is worth $20 million. So, suppose you have a company that has a free cash flow of $30 million. You're going to get that forever. We're going to calculate the value of operations by taking the free cash flow. There's no growth, but if there were, we would add to it that way, divided by the weighted average cost of capital, and we would adjust that with growth. We would subtract growth from the weighted average cost of capital and would make it bigger. So this formula, which is ultimately going to be $30 million divided by 12%, is going to be the way we're going to determine value for this company. Does that make sense to everyone? So this is just a little bit of an expanded version of our perpetuity formula. And it's going to give us a value for this company that has $30 million cash flow a year, free cash flow, value at $250 million. So when we walk into this company, we see that they're valued at $250 million. And we are going to try to increase that value as much as possible in the best interest of the firm. All right, other data. Company has no short term, no preferred stock, 10 million shares outstanding, yada yada. So suppose this company we valued at $250 million as a total value of operations, including any spare cash they might have having around, which they have none. It's just $250 million. None of that goes to the debt holders. So the total value of stock is $250 million, 10 million shares. Price per share is $25. So this company says to us, oh, come Mercy College MBA students, increase the value of our stock. Let's get that up to 26 or 27. What can you do for us? So what might we tell them? How are they going to increase the value of that stock? Issue debt? Yeah, we're going to tell them to issue debt. All the way up until the point when value starts going down. And one other thing we'll add in is we might suggest a reserve borrowing capacity. So we might tell them to issue debt not till that peak, but just a little bit before that peak, so that they have some reserve borrowing capacity. So we say that's our game plan. We're going to go talk to our investment banker friends. We're going to find out how much you're going to have to pay for debt when you issue it. And we come back with this. We say, if you become a 20% debt firm, you're going to have to pay an interest rate of 8%. 30%, 8.5, 40%, 50%, yada yada. So the cost of debt goes up as we take on more of it. Reason is, investment bankers look at us and say the more debt we take on, the greater risk we're taking on. The greater risk, the more they're going to charge us. Okay. Another thing we need to consider before we do our calculations of value, we see how the cost of debt goes up the more and more debt we take on. The cost of equity is also going to go up the more and more debt we take on. And this reason is the same, it's risk. The equity holders look at examples just like this that we did at the beginning of class and say, if you're going to be taking on more debt, you're a greater risk, I'm going to demand a higher return. And how we're going to calculate that higher return is we're going to change the beta. This beta of this company used to be 1. Now it's going to be different because it's a more risky company. So is that beta going to be higher or lower? You're pointing up or just scratching your nose? Higher. The beta is going to be higher. All right, a higher beta means more risk. So we're going to learn a quick formula, how we can increase the beta. This is called Hamada's formula. Beta changes with leverage, blah, 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 whatever. Here's the formula. The beta, after we lever the firm, is the beta of the levered firm times this nonsense, which is 1 plus 1 minus the tax rate times the weight of debt divided by the weight of stock. Let's just look at each of those components really quickly. 1 minus the tax rate. So the higher tax rate, would that mean a higher or lower levered beta? All right, I know it's late at night. All right, I'll try this one more time, and then I won't hold it against you if I have to give you the answer. So I said, so the higher so if this tax rate gets higher, is that going to result in higher of this beta or lower of this beta? So, what's lower, or one vote for lower? Actually, I don't even remember now. All right, so, so higher tax rate means more benefit for debt, right? Higher tax rate means more benefit, so that means lower beta. So, the higher this is, the lower number this is going to be. because it's a 1 minus. So higher tax rate, lower beta. Higher weight of debt. It's a little easier to figure this one out because it's just multiplied. So the higher the weight of debt, the higher beta. And vice versa for the weight of stock. Anyway, whatever. That's our formula. We just know that we need to change the beta, and that's the formula we're going to use to change beta. So let's look at each one of these points. We've got 1, 2, 3, 4, 5 options. For each of them, we want to figure out, we've already been given the cost of debt. We want to figure out the cost of equity. And then we want to find the weighted average cost of capital. And then we want to find the value of the firm. So suppose we're going to do 20%. The first step is to find out what would be the cost of equity if we are a 20% debt firm. We're going to do that, first step, by calculating the new beta. Find the new beta. So the beta previously was 1. Tax rate is 40%, excuse me. The weight of debt is now 20%. Weight of stock is now 80%. We're going to crank that out, and we're going to get a higher beta, 1.15, because this is now a more risky firm. Then we're going to use our CAPM to find the cost of equity. Previously, with a 0% debt, our cost of equity was 12%, right, if you look back a couple slides. We're going to now plug the new beta into the CAPM formula. I think the risk-free was 6%, the market risk premium was 6%, so it used to be 12%. Now it's a little bit higher, it's 12.9. So, since we've taken on 20% debt, we used to have a 12% cost of equity, now we have a 12.9 cost of equity. We used to not pay for debt. We used to have, I guess it's 0. But now we've got 8% debt. So now we're adding in this 8% debt, and that's, but we're going to have to increase our cost of equity to 12.9%. So, what happened? What am I doing? Okay, so now we calculate out the WACC. Our WACC, 20% is our weight of debt, 80% is our weight of equity. We have the tax benefit for debt. We have the cost of debt at 8%. Equity, again, is 80%. And we have the cost of equity at 12.9%. So our WACC, if we use 20% debt, is now 11.28%. Now, what was our WACC before we started this process when we had 0 debt? $20? 20% was the amount, was the weight of equity, was the weight of debt. The WACC was 12%. So it used to be 12%. Now it's 11.28%. So because the WACC has gone down, what happens to value? It goes up. So we're making progress here, right? We're headed in the right direction. Just by moving to 20% debt, we could increase the value of this firm. Because we're going to take advantage of some tax benefits. And we're not going to get hurt too much by the risk of financial distress. What we would want to do is repeat this for all capital structures under consideration. We just did 20%, now let's do 40%, 60%, 80%. And if we do that, we come up with these numbers. The 20%, we went through and we found a beta. If we become a 20% debt company, beta is 1.15. and we calculated a cost of equity at 12.9 and a weighted average cost at 11.28. If we were to repeat the exact same thing for 30% debt, we would come up with slightly higher beta, slightly higher cost of equity, but because we're combining it with a lower cost of debt, we would get a lower WACC. So take a look. As we go from 0% to 20% to 30%, 40%, 50%, our WACC starts at 12%, goes down, and starts going up again, and goes up further. So what might be our optimal capital structure? Okay, yes, you're on the right track. The 11.1 we like because it's lower. So what is our optimal capital structure? And I use this term just to reinforce the learning point because capital structure seems like a confusing term. But it just means the percentage of equity and the percentage of debt. So someone asks you, what capital structure? You know the answer they're looking for is some percentage of debt, some percentage of equity. So, what are you going to tell the firm is their optimal capital structure? 30% debt, outstanding. 30% debt is the optimal capital structure for this firm. So we've done it. Just have a few more things, details to clean up. To review, let's take a look at all these different rows. So at the top we have the weight of debt starting at 0 and all the way up to 50%. And as that debt goes up, let's look at the cost of debt, RG. What's happening there? Someone explain that line to me. We get one volunteer to tell me what's happening and why.
Cost of debt is going up.
Why?
The weight of debt increases?
Yes, but I'm looking for more. Why is the cost of debt going up as the weight of debt increases? Interest goes up. That's the same thing as cost of debt going up. The interest goes up. Don, help us out. Why is the cost of debt increasing? Don? Why is the cost of debt increasing? Okay, so the interest is going up, but why is the interest going up? Okay, but you're still just saying the same thing. The amount is going up and the interest is going up. Why? Why are we being charged more? Risk. Risk is higher. As we take on more debt, risk gets higher because of this example. So the investment banker or the commercial banker is going to say, I'm going to charge you more as your weight gets higher. Your weight of debt gets higher. Weight of stock, this is just the mirror image of the weight of debt. Beta, this is the beta for the equity. This assesses the risk. So someone tell me what's happening there and why.
Beta is increasing
Yes,
as debt
yes,
increases
yes, Phoenicia. Why is the beta increasing as debt increases?
because
Because of
of the risk.
the risk. And we use that new formula to calculate what the beta is. So beta increases because of the risk. And so that's going to inform the cost of equity. Debt increases. The interest rate increases because of risk. So then the return required by the stockholders, RS. What's going on here and why? Janelle?
It's going up.
Yes, why? safe bet. Just say risk, and you've got a good chance of having the right answer. All right. So the amount we have to pay on debt is going up because of the risk. The beta goes up because of the risk. And as the beta goes up, so too mathematically will the cost of equity go up. Now, what's happening on this final line, the WACC? Going up, down, stay the same, and why? I hear mumbling somewhere. I can't identify who it's coming from. Ananya? What's that? It's decreasing. Okay, that is not right. It decreases and then it increases. Yes. Okay, so it decreases and then it increases. Why? Elaine, help us out. Why does it decrease and then why does it increase? All right. So it decreases from here to here because we're incorporating this lower cost debt. So our cost of equity went up a little bit from here to here, but we mixed it up with lower cost of debt. So the result was when we combine that together, it goes down. Same thing when we go from 20% to 30%. Our cost of equity went up a little bit, but that was offset and then some by the fact that we mixed it up with 30% of an 8.5 rate. So we're paying 70% of a 13.5, 30% of an 8.5, plus we get a little tax benefit. So our weighted average cost of capital went down. So as we take advantage of the tax benefit, the WACC goes down and value goes up. There gets to be a point at that optimal capital structure where the cost of financial distress make the cost go up, make the weighted average cost of capital go up, and more so up. So our optimal capital structure is 30% debt, because there, up until that point, the tax benefit helps us and the lower cost of debt helps us, but then the risk of financial distress, because everything starts getting too high, hurts us. Make sense? So, and then there's one little kink we want to add to that. Do we want to tell our client, you should be at 30% debt? Is that our final recommendation? Who said no? Yeah, no. Why? Leave room for reserve borrowing capacity. So maybe we want to recommend to be right here. So this might be our recommendation. Go to the capital markets, get 20% debt, use that money to repurchase stock. You're going to have a lower cost of capital, a higher value, and you're going to have some reserve borrowing capacity. That is our recommendation. That is what we tell you. Weighted debt, 20%. We're going to plug that into our perpetuity formula, the $30 million of free cash flow. Now, that doesn't change. Just like we talked about some examples. This doesn't change. The only thing is the discount rate for that is going to go down to the 11.28%, and it's going to give us, it used to be a value of $250 million, now it's a value of $265 million. What else do we have here? 20% of that is going to be debt. 80% of that is going to be equity. So of that $265.96 million, 53 belongs to the debt holders once we become a 20% debt company, and 212 belongs to the equity holders once we become an 80% equity company. Okay, where was I? Yeah, all right, so this is just that same graph, weight of debt, or same chart, excuse me, 0, 20, 30, 40, 50. And we just calculated the 265 million at 20%. It could be higher at 30%, but we want to maintain a little bit of reserve borrowing capacity, so we're going to recommend our clients stay at 20%. Some of the numbers with that. So before debt, we had a value of operations $250 million. We had a stock price of $25 per share. Now we go to the investment banker. What do I want to do? Yeah, I want to see this. Yeah. Now we go to the investment banker. The investment banker gives us $53.19 million in cash. We are going to, so we have a total value of our company plus the amount of cash we have on hand, but 53.19 of that belongs to the bank. We've increased our stock price to $26.60. $26.60. I'm going to run through this last part fast because you've got the intuition. I don't want you to get bogged down late at night on these numbers. Stock prices increases, wealth of shareholders due to ownership increases. When we actually so we're going to use that money we borrowed from the bank to repurchase stock. And you may remember from last week, when we repurchase stock, the actual repurchase doesn't make the stock price change. It just changes the shape of the pie. So we're going to use some of the stuff we learned last week to figure out how many shares this $53 million is going to buy in equity. And it turns out, if we divide that $53 million by what the new stock price is going to be, $26.60, it's going to come out to about 2. We had 10 million shares before. Now we have 8. And it's going to give us this final column. After the repurchase, our value is going to increase to $265 million because we become 20% debt. And $53 million is going to be owned by the debt holders. Leaves $212.77 for the equity holders. We have 8 million shares, $26.60. Have key points. Short-term investment fell because we used that to repurchase stock. Stock price is unchanged. And we've got some reserve borrowing capacity. What else did I want to do here? Okay. All right. Okay, so we can go through that example again, but I didn't want to spend too much time on the nitty-gritty of that because I was happy with the intuition that I think you understand with how we're going to choose that. But I will spend more time if we have specific questions on it. Let me just see if there are any questions right now, and then what we'll do is we'll take a break and we'll leave time for a few more questions after that break, or review like we do at the end of class every time after the break. Are there any questions just overall on the math of this example? All right, fantastic. So you seem to understand the intuition very well. Forgive me for reiterating that over and over again, but it's important with these confusing theories. This was actually the last new content for this class. This is class 8. Next week is just a review for the final, which is everything. Everything class 1 through 8. We'll review that material quickly, and then we'll use as our study tool the quizzes. The final exam will be very similar to the quizzes that you've taken each week. So next week we'll go over the basics of class 1 through 8, and then we'll turn to the quizzes and we'll just work through those, see if you have any questions on those. And then 2 weeks from tonight, we'll take the final in this class, which will be 2.5 hours. I'll give you more information on that. You can use a calculator, just not a cell phone calculator. You can use books, notes, anything that you've taken. Just must be done independently. So with that, we're going to take maybe a 5-minute break here. If you feel like you understand the material from class and want to go home, that's fine. Otherwise, I'll be here to review this math at the end, or any other questions you had, or any questions on the quiz that was due this week, or any other previous material. So let's take 5/go home. Your choice. Yes. Long-term investment? It's not a big deal. It's just like a cash account. It doesn't matter whether you call it short-term investment or long-term investment. I guess they're calling those short-term investments. An example, and just to clarify that it's going to be gone soon. It doesn't matter. The math, whatever you call it, the math. Yeah, all right. Thank you. Did you say sounds legit?
Yeah.
I like that. Awesome. Read up. Yes.
Would it be possible, I don't know if you had time between it, to give like a makeup quiz for people, like just a general one, just to see if someone wanted to increase their grade?
Oh yeah.
Like if they could do something like a makeup quiz.
Well, what do we have? Well, the rule on that is everyone gets one makeup quiz. Yeah.
Oh, okay. You just open up the same one, not nothing
Just
different.
open them, and I believe you are.
I did open up one. Yeah, I had that one for the second one. I was just asking for last week. For last week, when I took it, I had a family test. I just feel like I didn't really put in my whole time to it.
All right. Well, so like I
That's why
said, the
they-
final will be very similar
so yeah.
to the quizzes.
The
How many questions do you want?
10.
10, right? If we could. Well, it depends on how hard they are.
Yeah, that's the thing. And if you miss one,
That's it, right?
Yeah,
If-
it's over. It's over.
yeah, if you miss 2, you're down to like a B-.
Right.
And how many percent of the silent grades? 50%?
I think it's a lot because
It's not 50.
I think it's like 38. It was like 40 or 38.
38.
It was 38% of your grade.
It's a lot.
yeah, So-
I'm okay with 50 multiple choice questions.
50 multiple choice. Okay, I think that's what last time I taught it. I think I had 50 or 60 multiple choice. I haven't decided how I'm going to do it this
He
time
said
though.
50, 60.
But what about those calculations when you use, how?
No.
Like, it's not going to be here.
Yeah, there won't be on the exam. Yeah. Yeah. I'll make it
A
up.
lot of theory questions or most calculations?
The best way to answer that is pretty much like the quizzes. I'll
So some
Yeah,
Yeah.
mixture of everything.
I'll look at the quizzes. I'll say, oh, that was a good question. Let me put one similar to that.
Okay.
Or that was kind of a question we didn't end up talking about in class, so I'm not going to put that. Something that's manageable in the 2.5 hours, and especially because it's going to be so similar to the quiz, you should be able to do those questions like that.
Yeah, but you see, environment is different. At home we are relaxed, and here like
Stress.
you have to give us some.
No,
I'm
I
not
think
relaxed
I would
even at
rather-
home when I
No,
do
because
it.
the time is in front of you. It's like, yes, you don't want to run out of time. You
I'm
see
like
people-
stressed. And when that
Yeah.
Every
silly
Sunday,
clock